Hello, everyone, and welcome to Real Estate Right Now, where we talk about real estate matters that matter to you. My name is Jay Izzo, and we are live here from Linden Craft Team Studios here in Raleigh, North Carolina, part of the Research Triangle Park. I almost forgot where we're at. We are in the Research Triangle Park. We're here. Today's show, let's talk about insurance for your home. Many of you who listen to the show, either your first-time home buyer or some of you are luxury buyers. You have luxury homes or you have new homes and they're your first home. Some of you are right in the middle. And there's a whole variety of questions of how that's different, how insurance coverage is different for your home, depending on what your home is. And people have tons and tons of questions. They always ask. And Bryce Williams with Harbor Trust Insurance, owner of Harbor Trust Insurance,
indeed,
joins us for the third time on the show. I actually didn't remember the first time. I remembered the second time. I didn't remember the time before, but I brought him back because we just recently did a luxury show, and it started raising questions for me about how that's insured. And then I want to kind of compare that, some questions from a first-time home buyer's perspective, that messy middle, where you're at in the middle sometimes, because our average home price is around $450,000. And then you've got the luxury buyers and the ultra luxury that are over $1 million, sometimes over $3 million, as much as over $5 million. And so there's a lot of difference. So Bryce, welcome back to the show.
I appreciate it. Thank you, Jay.
So let's just dig right in for the new home buyer. Oftentimes, a lot of first-time home buyers confuse what they paid for the house with what it costs to rebuild it. Can you explain why insuring for quote-unquote market value is often a huge mistake, and how restructuring cost is actually calculated?
So insuring for the market value of a house, oftentimes for the homeowner, is going to leave them paying more money than what they should. Market value is going to include the land and the building. The insurance company is not necessarily at all concerned about the land. The land, the only concern that they have is, where does the house lie? If it's, they may have restrictions on that. But the land itself, the insurance company is under the belief that it's always going to be there. The house could burn down to the ground, land's always going to be there. So we're not concerned in including the value of the land in the amount that we're insuring the house for. We're strictly looking at what it costs to rebuild the house. So when you think about all the materials, and we look at doing a home evaluator, which is a system that every insurance company has to determine the amount of insurance that they believe is required to rebuild the house per the specs of the home. So we take into account the square footage, the ceiling heights, the number of floors, the flooring makeup, the wall makeup, whether it's an older home that has a lot of plaster or whatnot. Nowadays, most every home has drywall, but all those things are coming, or all that comes into play to determine how much it costs to rebuild your house. So if we took a house in, let's go where I live, Wake Forest, and we took that house and we put it on the coast or right on the beachfront, you're going to see the value of that house probably skyrocket by $500,000 or $600,000.
If not more, yeah,
right. But it doesn't take that $600,000 or $700,000 more to rebuild the house itself. It is, what you're buying is the location. So in that instance, you want to make sure that you're not overspending just to cover something that you think is going to get that you need to cover, when the value of the land is much of that purchase price.
Okay, you did say something there that struck me, and that was height of ceilings. Help me understand that. Because I'm like going, okay, when you say height, I mean, because that's just an odd thing that just,
you don't necessarily think.
I don't think of that. So yeah.
So ceiling heights, let's say that we have house with 8-foot ceilings versus a house with 10-foot ceilings. Well, there's 20% more drywall or 25% more drywall and materials sometimes for that. Okay. So all those small things come into account. Just like if a one-story home versus a two-story home, they may have the exact same square footage, but it's going to take a little bit more to rebuild that one-story home because of the amount of foundation that has to be made. It's going out laterally as opposed to vertical.
Okay.
So those are subtleties.
Yeah. So now it's also giving me some other thought processes here. Like, if you have a turret, the turrets that,
Roof, yeah.
that you have your office in, it's in that kind of round shape.
I'm aspiring to get a turret one day.
A turret,
Yeah,
right?
I know what you mean.
But it's more expensive to build a turret.
Yes.
So that has to be considered then too, in terms of when you're pricing the policy and what you're covering, because the expense of rebuilding that is quite expensive.
And when we talk about, I know when you look at roofs, just like you mentioned with the turret roof, gable roofs, hip roofs, some of these really elaborate roofs that have a lot of dormers and a lot of, peaks and valleys. It's going to take more to rebuild that roof than it is a standard gable roof that only has two vertical sides and just meet in the middle.
Right.
So all of those nuances and subtleties of what makes your house yours makes a difference in the amount of insurance that you need to carry. So the conversation with the agent needs to be had and make sure that they can reproduce that home evaluator for you to kind of say, hey, we know what your house looks like.
Right. Got it. That's pretty cool.
Yeah.
I never thought about it. So sometimes new buyers are often strapped for cash.
Mm-hmm.
And they want to just get the cheapest premium so that they can satisfy the lender. When they strip down a policy, what are the first critical protections they usually lose without them realizing it?
So the good news for the average home buyer is that the insurance companies have tried to, for lack of better words, or simplify. I was about to say dumb it down, but simplify the process and the packaging of all those things. So generally, the crucial items that you need to make sure that you've got, like personal property replacement costs and expanded replacement costs, or some provision that increases the amount of coverage if needed. Those are typically already baked in. Typically. So, it does make sense to go in and make sure that you have those. Look at your policy just to make sure that you haven't neglected getting those. But those would be the two things in the past that oftentimes could fall off. So the insurance companies have done a good job at simplifying it for 95% of the home buyers out there. But the biggest things that you want to make sure is that you have a copy of that home evaluator, because that says, hey, my house is insured to value. And that's the biggest mistake that you want to avoid. Sometimes where I see that mistake being made the most, where they're being penny wise and pound foolish, is on the home investor side of things. We've got some clients of ours who have gone all in on it, buying investment properties and turning them into landlord rental streams and income rental streams. And a lot of those times they look at it purely on a business transaction and they say, hey, I bought this house for $100,000. And the insurance company is saying, well, it takes $180,000 to rebuild it. Oftentimes those home buyers or those landlords will say, hey, I just want to insure it for what I've got into it. So they shortchange the amount of coverage. And so they end up, you just need to be aware that you're going to end up holding the bag. So you may be saving $200 or $300, but in the end, you may find yourself having to come out of your own pocket for another $80,000 because you're being a little, penny wise and pound foolish. Now, if that's a risk that you're willing to take, the insurance agents will oftentimes let you do it, but we're going to make you sign a number of things to make sure that you know that, hey, we've taken out some things from the policy per your request.
Okay.
But for the most part,
it's already baked in.
Generally already baked in. But the big things that you want to look for are the personal property replacement cost coverage, because that makes sure that, if you've got a big screen TV that you bought and, you paid $2,500 for it, that they're going to give you what it costs to replace that same TV of like kind and quality. Say it was a Sony, Bravia or something. You want to make sure that you've got the money instead of just them valuing it as, oh, well, what could you have sold that 5-year-old TV for today? That's the difference between personal property replacement costs and not having it. Is they're going to give you the depreciated amount if you don't have it. But 97, 98% of the time, that's already baked into the policy, but it's a good thing to double check.
Well, that's awesome. Most people, I think, believe that water damage is covered, which I believe, when they get a water damage, right, they think that's one thing. Can you clarify the massive difference? I don't know if it's massive, but a difference between a burst pipe, a sewer backup, and a flood, and why standard policies often leave those two things uncovered?
So I do love the question, because I don't hear that question worded with all three
Right.
very often. So a burst pipe, that's something that if you've got your standard homeowner's policy in North Carolina, that's automatically going to be covered. So a hot water heater or a burst pipe inside the walls, that's covered. When it comes to water sewer backup coverage, that's one of those that you actually need to endorse onto the policy because it's not baked in like the other coverage is, like the burst pipe. It's not baked in. So I start heavily suggesting water sewer backup coverage. And when I say heavily suggesting, I mean, I get a little preachy on it to make sure my clients who have homes that are 20 years or older, or if you've got a lot of trees in the yard, have that added on. I will see policies that have it added on, but there's $5,000 of coverage. And I can tell you from experience, any water sewer backup event is going to quickly exhaust that $5,000. Yeah, I'm not going to say every single time, but all of the ones that I've seen have easily gone north of 5,000. So if you see on your policy you've got $5,000 of coverage, I would essentially look at that and say, yeah, I really don't have coverage because you're also subject to your deductible. So bump that up. But water sewer backup coverage, it covers the main two culprits are going to be tree root systems growing into pipes and sending that sewage back into the home. So whether you're on the city sewage or you're on a septic system, you just need to be keenly aware of where the trees are, you know, like a eucalyptus tree or a willow or something that's going to spread out their root systems very quickly, can overwhelm pipes and choke them looking for water and send that sewage back into the house. So that's what water sewer backup coverage is designed to do.
Got it.
So, and then flood is a whole nother policy that is completely separate from the homeowner's policy. Typically, that's in, I'll talk about in the traditional sense. It's always been a FEMA policy, something that you have to pick up through a FEMA appointed company. Nowadays, we also have private insurance companies that have really become a little bit more prominent in the last five years or so, maybe 10 years. We've got companies like Neptune Flood that we can pick up policies through, and they give us the opportunity for, on a number of fronts. One, it goes above the $250,000 maximum that a FEMA policy will do. It will go up to oftentimes $5 million in coverage. Now you're going to pay for that $5 million, but if you want to make sure that you've got more than that $250,000, private insurance is the way to go. Unless you pick up an excess policy, but that's getting into the weeds of things. The private insurance will also give us personal property replacement costs that a FEMA policy doesn't. Private policy also gives us the ability to add on loss of income or loss of use coverage because a FEMA policy doesn't pay for you to live elsewhere. But the private insurance companies, they've built that in. And you can also cover pools.
Got it.
Which FEMA policies won't cover pools. And coverage for in the basement. You can get $10,000 of coverage in the basement. So the private companies, they're newer to the scene, but they give us the ability to really get a more robust policy and cover certain things that you can't get through FEMA. Now, the insurance companies have also started rolling out their version of flood policies as a endorsement onto their homeowners policy. And that's been probably in the last 3 years. Some of our carriers have come up with what they may call extended water coverage, which is covering a lot of the things that flood is designed to cover. And you can just build it onto your policy. It's a little bit cheaper, and it does not, it's just an endorsement to add on to your homeowners. So to summarize, the burst pipe, automatically covered under your policy. The water sewer backup coverage, we need to endorse on. And flood, which is rising water. Anything that comes from the outside and during a storm, think of it as needing to be covered under flood. So that's where you would get your policy, and you need to pick up a flood policy or ask your agent if that company writes an extended water endorsement onto the policy.
I know that, like we have some areas here in the Triangle where they're in floodplains, right?
It's becoming more prevalent. Yeah.
Right.
And it can change. Year to year.
And then I know down at the beach, in Carolina Beach, for instance, that's kind of like an automatic thing if you're going to have a flood policy because, I mean, it just happens. We get flooding down there with hurricanes, storm surges and things like that. And we have something called king tide, which every now and then rises up. And if all the things connect where we get a storm during king tide, things can get really, so those policies become invaluable, especially down there. But, if you're down at the beach, it's kind of what you expect.
It is.
And if you're in a
Yeah.
floodplain, even if it's a 100-year floodplain, don't assume that it's that this is year zero and we're waiting 100 years.
I was literally about to say the same thing. Don't think the clock resets when you buy the house.
Right.
Yeah. You may be in that year 99.
Yeah.
And there may
right.
be 3 floods in the next 100 years because it happens.
Yeah,
Nature happens.
Yeah, it does. Let's talk about people who are upgrading and renovating here for a second. Construction costs have risen and significantly, I would say. If someone bought a policy 3 years ago and hasn't looked at it since, are they automatically underinsured today? And how often should we be auditing our coverage?
So I would look at the coverage probably every 3 or 4 years.
Okay.
So that 3-year number is fair. The insurance policy that the insurance companies provide, the vast majority of them have a provision called inflation guard protection. So if the house, you purchase a home for $100,000, I'm using easy numbers for my simple mind. And next year it may bump up to $104,000 because that year the insurance company, looked at the overall cost of materials and they were comfortable with saying it's 4%. So automatically that will bump up your policy year over year. It may vary. Some years they may have some catch up years. I know we did during COVID. Because construction costs just went crazy.
Yeah, it did.
So that provision is there. What I will add is if you have made any changes to the house, I'm talking about beyond paint. Right. Most people will paint, in certain rooms. That really doesn't add anything to the cost because we're just going to replace the same paint.
Right.
But if you make some kind of material change, remodel your bathroom, change out countertops, redo or replace your cabinets, you're actually making different material choices in the house that impact the cost of the rebuild. If you add on square footage, oh my goodness, please call us. So as soon as you start construction, call us. That way we can kind of figure out who's carrying the insurance on it. Sometimes the builder will carry the insurance under a builder's risk policy. And then you're responsible for as soon as you get that CO and your certificate of occupancy and that's relinquishes them from being responsible for it. And you need to pick up coverage. So just know that during a remodel, if you're doing one, have a conversation with your agent first in the early days of planning. So and you can kind of figure out if you're responsible for carrying the cost of the coverage or if the builder is. But if you've done any renovations, just give us a call. Generally, we always have the home evaluator that we'd previously done on the house in the system and we can just update it.
Right.
So there are also 2 different types of policies where some of them are going to have a co-insurance clause in there. Well, they're all going to have co-insurance. Okay. But if you dip below 80% of what the value of your house is for the amount of coverage that you've got, you start to run into some actual cash value and co-insurance clause issues. So just making sure that every 3 or 4 years you've touched base with your insurance agent in the off chance that something's not working in the policy as far as keeping up with the construction costs and just have them update that home evaluator.
Great advice. I just outstanding advice. It's just, I love that. We've got Airbnbs now, right? So we got a lot of homeowners who are generating some extra income through an Airbnb, short-term rentals, or maybe they're running a business from their garage. At what point does a standard policy say, no, we aren't going to cover that?
So the Airbnb one has been new to the insurance industry. They've had to kind of figure that one out in the last 10 years. But most of them are starting to build in home sharing provisions into their policies. Okay. But you definitely want to call your agent just to make sure and see where that company lies with it. But when it comes to the business aspect of things, a lot of us have hobbies. And we like to go into our hobbies pretty hard. And I'll give a mechanic as an example. A mechanic is free to absolutely work on their car and everything, work on friends' cars at their house and help out and whatnot. But as soon as there is some kind of exchange of money and there's a profit beyond just reimbursing them for a part, but if you're making money and generating revenue off of the equipment that's in your house, you need to have a conversation with the insurance agency and with the insurance agent, because a lot of times once you start accepting money, it becomes a business situation.
Right.
If you have a printing machine in the garage and you're printing out, let's say menus for restaurants and things like that, and you're just getting started and you're still looking for office space. Well, at this very moment, you've got a business going on, and that property, and let's say it's a $10,000 printing machine, you may have a limitation on your policy for $2,500 for business personal property.
Mm.
And you also may be negating liability coverage when something happens because somebody came on the property to pick up an order and they get injured. Well, they were on the property for business, not a personal policy. So your policy covers you for personal liability, not business liability.
Mm.
So definitely have those conversations.
So then I'm going to have another. Is it an endorsement? Is it a separate insurance?
Yeah. So there's certain industries that the insurance companies have become okay with, and let's say that you've got a beauty shop on the side of your house, and you cut 2 people's hair per day or something like that, and it's just you. That's all well and good. We can probably add that onto the policy. You don't necessarily have to go out and get a different business owner's policy or something like that for that. But in those situations, that's generally endorsable onto a homeowner's policy. A daycare, if you have, let's say, up to 3 or 4 kids, if you've got a small place in your house and you have 3 or 4 kids, you just need to make sure that you're operating within the guidelines that the insurance company is okay with. So if all of a sudden you've got 8 kids, that's a substantial, greater risk than what the insurance company wants to take on a personal homeowner's policy. So, it can be added on oftentimes, and there's certain classifications, like I said, with daycares and beauty salons and whatnot, but there's others that are just big no-nos. Okay. If you're running, obviously, pretty extreme example, if you're running a firing range on your property.
Okay.
There's degrees.
Right. Okay. All right. So let's move to the luxury market now and ask some questions here. Let's say I've the luxury home. I have hand imported Italian marble floors and custom plaster molding, and a standard policy might only pay to replace them with a standard builder grade materials, I guess. How do luxury policies handle like, kind, and quality issues differently?
So when it comes to luxury homes, the good news is the like, kind, and quality is baked into the policy. So when you get that luxury home, it's oftentimes written on, not to get too in the weeds, but on what's called an HO3 policy or an HE7, depending on the carrier that you're working with. Mm-hmm. Both of those policies are going to have provisions to where they give you, as long as you've got personal property replacement costs, or you've got the dwelling is covered for replacement costs. They're trying to do like, kind, and quality just the same. They want to bring you to the point that you were prior to the loss, no more, no less. They want to indemnify you.
Okay.
So that's their principle. So, but the key thing is making sure that you have enough coverage. So whether it's a $400,000 house or a $2.5 million home, the provisions in that policy are the same because it's a standardized policy. It's the HO3 or the HE7 homeowners policy. It's it's homogenized among all the carriers.
Got it.
But different carriers are going to have different appetites. So not all carriers are going to be okay with doing a $2.5 million house. So there are less and less. There is a narrow scope of companies that want to put themselves on that kind of a risk because maybe their financials don't support that exposure. Like they can handle 1.5, and that's where they draw the line. But when it comes to making sure that you've got coverage all the way through and that you've got enough coverage, the nice thing about and the nice fail-safe 9 times out of 10 with luxury homes is that you're in a amount of coverage that the insurance company is going to re-verify. So as an agent, I can do a home evaluator. Now, I'm not a home builder, but I have the tools and I've done it enough times to where I'm pretty darn close on my work nowadays, but I'm not perfect. So what's nice is that the insurance companies will generally, within about 2 weeks after the purchase, send another high-end home evaluator person to appraise the home, go in and out and do all the measurements, and they'll double check the work and make sure that they've got the amount of coverage that they need. And they may force us to bump the coverage up, but that's good. And what the homeowner needs to understand is, hey, I just want to make sure that I'm covered, that the promise is going to be kept. I understand that you guys have a difference of opinion in what it costs, And it's amazing how many times we all try to play professional and make the argument of, oh, no, I've looked on the internet and it costs $200 a square foot to rebuild. Dude, where'd you get your certifications from?
Right.
So trust, unfortunately, we need to trust the people that they send out to do that, as long as the information is correct.
Right.
I've seen times where they've come back and they've had the square footage was off and we could prove it. But that's where we double check the work. So that's a nice thing on the luxury market, is there is typically a fail safe to make sure that they've had two sets of eyes on the risk to make sure you have enough coverage.
Well, you said something here that leads me to another question, or I don't know if it's a question, but maybe a thought. And that is, so what I'm hearing from you, as the higher the price of the home, you actually have fewer and fewer companies that may cover the home. Is that fair to say?
That's fair to say. That's fair to say. Now for the majority of the homes that are sold here in Raleigh, most insurance companies will cover them. But as you get into the ultra luxury, and let's just say you get over 1.5 million, it starts, the number of companies that want to take on that big of a risk starts to narrow.
Yeah. So for instance, we have a listing that's over, 5.5 million. The number of companies that might be willing to insure that pool is much more.
Yeah, it definitely narrows.
Okay.
I'm not trying to say it in a scary way.
Right. No.
But it's, if I was to go out and say, yeah, I can cover the cost of that, and I'm individually insuring a house, my pockets are going to be different than your pockets. And so the same thing happens with the insurance companies, is some of them are more regionalized and they have a smaller footprint, and they may not be able to weather bringing on, 8 to 10, $5 million homes in Raleigh, and it's a concentrated risk.
Right.
For them. So if a hurricane comes through, it's a very concentrated exposure that they're gonna have to pay out a lot for.
Yeah, I can't imagine what the insurance, because the Hamptons, for instance, right, where those homes are, tens of millions of dollars, if not more, right? Or it's some places in Florida, San Francisco. There can't be that many companies that are willing to take those risks on. I can't believe that.
Yeah, it is definitely not Junior's Insurance Group.com. That's not the one that's going to handle that one.
Right.
Junior's still trying to get into adulthood.
Right.
But you do have some long-time companies that have reinsurance contracts and a good track record and have been around for a while. So you want to make sure on those homes that you have a company that is financially sound, and look at their AM Best rating.
Oh, that's a great suggestion.
Yes. So there is movement that has occurred in AM Best ratings in the last 5 years.
Okay.
You want to make sure you're with at least an A-rated carrier most of the time.
Okay.
Yeah, it can be restricted. Like when you get out to the coast of North Carolina, there are fewer and fewer companies that want to be on that coastal risk. So we have a fair amount of, that's one of those markets that's really tightened up and has limited, insurance companies.
So like a figure 8 island, for instance.
Yeah.
That could be that's a little bit more of a.
Correct. Redanthi.
Oh, yeah. Okay.
Some of those areas, especially some of those homes that are right there on the water.
Right.
The insurance company's not interested in insuring that house that is on stilts and high tide goes underneath. Right. Yeah.
Well, we've all seen the pictures, right, of when the hurricanes come in and we see a house somewhere on the coast and it's floating out into the ocean, right?
And we all question, we're like, who is insuring that? Why are we insuring it?
Right.
But we don't necessarily look inward when it's our house and it's 2 rows back. They're like, oh, it could never happen to mine.
Oh no.
But when you look at those, allow yourself to sit in the position of an underwriter and realize, okay, they do have to have some rules.
Right.
So there's guidelines that reemphasize, hey, we don't want certain exposures. Some of those are too risky for us.
Yeah, I get it. Luxury estate, let's say a luxury estate suffers a fire. Family just, can't just move into a standard hotel room for 6 months and maintain their lifestyle. Can you explain how additional living expenses differ in high net worth policies compared to standard ones?
So the difference is going to be, and again, keep in mind that they're going to generally calculate that as about 20% of what you insure a house for. So if you insure a house for $1 million, typically your loss of use coverage is going to be about $200,000.
Okay.
There are some companies that differ, and they may go to 25, or they may have their different configuration on it. but the provisions in the policy are generally the same, is that they want to make sure that they've, your policy has to pay for you to live elsewhere while they're rebuilding the home. Now, if it is a 2-month, it's going to be a 2-month process to get the house back together. They're not looking to sign a 12-month lease on a $3 million house. What they're going to try to do oftentimes in those situations is find a furnished corporate rental for you to reside in. It's not going to be your life that you had prior to the loss in this temporary situation. So I hate to say to temper down some of your expectations, but that's a good thing to do, is just temper your expectations. Now, they're also, if you can't make meals where they're having to put you up, they will cover the cost of food and going out and eating. Now, we're not saying go to Ruth's Chris or Sullivan's every night and whatnot, but something that is within
But
reason.
they're not saying McDonald's either.
Correct. No, they're not.
Right.
No, they're not.
Right.
They're and talk to your claims adjuster, and they'll kind of set the bar and set the stage for you. If it's within reason, they're very as long as you've had the conversations ahead of time, that they'll try to accommodate as best they can. There are some outrageous requests,
Right.
and it's a case by case basis.
Okay. So, but here's the thing I have, like some of these ultra luxury homes, are enormous and they're going to take longer. Some of these could take longer than a year
Yes.
to redo. And if it's only 20% of the policy and you've got one of those homes, and let's say it burned to the ground,
Yep.
and they're rebuilding it, and it could take a year plus, maybe closer to 2.
Yep.
How do we handle that?
So generally 20% is what they're providing you. And
So if you have a $5 million home, right, we're looking at $1.25 million.
If you feel like you're going to need to have more coverage, you can request and you can typically buy more coverage.
Okay.
Now there needs to be a justification for that.
Right.
So the underwriter's going to be like, hey, we don't get this request often. What makes them think that they're predicting the future and they have to have more coverage?
Right.
It's generally set. And if you need to pick it up and you feel like you need to pick it up, please do have that communication.
All right. That's good information.
Keep in mind that if you're buying a $2 million house, 20% of that is going to be $400,000. If you're buying a $3 million house, they're giving you $600,000. So it grows with the amount of coverage, the size of the house anyways.
Got it.
As well.
So oftentimes ultra luxury home buyers acquire high value items like art, watches, jewelry. Is there a grace period for those acquisitions? And let me give you the example. So for instance, if I buy a $50,000 watch, a $50,000 Rolex, right, on Saturday, and it's stolen on Sunday, am I covered?
Who'd you tell?
If I haven't called you yet, am I covered?
Did you tell that you bought it? Did you tell your friends? Because those are the ones I get. No. No. So, but that does actually lead into the answer is, did you tell your insurance company?
Okay.
So if you haven't gotten the chance to tell your insurance company, more than likely it's not going to be covered, because the insurance company needs to have a good reference for the value of it with a bill of sale or the appraisal, which also establishes the condition that it was in. You can't just all of a sudden, you've got to realize how shady that can be in that arena. If somebody calls in and says, yeah, I just had a $50,000 watch stolen. It wasn't on the policy. I just bought it. There is so much vagueness and gray area that it is hard for an insurance company to feel like, oh, that's legitimate. Right. So we need to have the appraisal, and it needs to be established the value prior to knowing that you've got coverage. You need to provide the insurance company the information so they feel comfortable with the risk. Some insurance companies won't do a ring over $25,000 or a single item over $50,000. They have rules because they don't want to take on that huge exposure unknowingly. They want to feel comfortable with the risk. So we need to establish the amount of coverage and do that as soon as possible. Because unless we've added it to the policy, you're going to be subject to the $1,500 limitation for a piece of jewelry per item.
Right.
So you've got a $1,500 limitation on the policy for any one item of jewelry in the case of theft, and it's subject to your deductible if we don't have it endorsed on. Once you endorse it on, then we can expand that coverage up to what that appraised amount was. And oftentimes, you'll end up with a $0 deductible, or some companies will let you choose a deductible to offset the cost to lower the premium.
So here's the advice I think I'm hearing from you. Correct me if I'm wrong.
Yeah.
Is I'm in Vegas and I'm buying that Rolex on a whim on the weekend because I feel like, you know what, I deserve it, or whatever the reason is.
You do.
Yeah. Okay. Yeah. And it's a Saturday and I purchase it in Vegas and I'm wearing that thing around and I get held up and that thing gets stolen. Is it one of those things? What's the protocol here? Do I leave you a message? What's the protocol if you're in that situation? Because I mean, this does happen. By the way, I have friends where this happens, right? Where they go and they buy, either it's a piece of art or they're buying a watch or something that's really, really valuable. And I mean, when I say $50,000, I am not joking about that.
Yeah.
And so, I mean, what's the protocol here then that they should do?
If it was me, I would tell them, hey, hold off on buying it in the exchange of money to where you actually have the financial responsibility and you financially own it. Try to do that on a Monday when we can add it.
But I'm leaving on Sunday.
I get it. Just know that there's a risk that you're taking on.
Okay.
And in those situations, it's not like the car insurance policy, where on a car insurance policy, if you show up on a Saturday to buy a car, which a lot of people do,
right? Yeah.
They buy cars on weekends.
Yeah.
Your policy, there's a provision in the policy that automatically extends coverage to that vehicle, that newly acquired vehicle. But it's not the same for jewelry, fine arts, anything. I would say in a catch-all statement, anything that carries an appraised value. Now, if you go out and you buy a $25,000 TV from Audio Advice or something like that, that is probably covered perfectly fine under your policy because that's a regular item that I could replace in the next week or two from another retailer. That's not a unique item. It is a very nice item, but it's not unique because we can replace it from an online retailer, whether it's Amazon, Audio Advice,
whereas that watch may not be. Well, first of all, it may be replaceable or it may not, but if it is replaceable, it may not be $50,000. It may be more.
Correct. It may be more. It could be less.
It could be less.
And the insurance company doesn't want to pay out $50,000 for a watch that was really just worth 20.
Right.
So you have to establish the value, and we have to make sure that, hey, we've documented that it does exist.
Right.
And that's real.
Yeah. Okay, good. Let's talk about liability and umbrellas with high net worth individuals, because they're often targets for lawsuits. Why is the umbrella policy arguably the most important yet cheapest piece of insurance a luxury homeowner can buy?
So you have to recognize when you have something to protect, and whether it is not just a luxury home owner or anything like that, but if you have a reliance on your assets and it would break your heart for those to go, definitely consider, first off, always max out your liability insurance on your homeowner's policy. It's pennies on the dollar. Difference between 300,000 liability coverage and $1 million, if the company will go up that far, is typically about $8 a year.
Oh, wow.
So it's a no-brainer. I automatically quote the maximum on liability coverage on all my quotes that I do. When it comes to, if you've got enough assets that $1 million isn't enough to cover, the percentage of assets that you've got that would tear you up, then absolutely look at picking up an umbrella policy. I give heavily preachy, again, I'll use that phrase, on my clients that are nearing retirement or fully retired to have an umbrella policy. Because at that point, you are at the very point that you are now reliant on that money and that nest egg, whatever you've built, to last the rest of your life. Your life may be another 10 years. It could be another 30 years. But if all of a sudden you're at the age of 70 and you have a car accident and your auto policy didn't have enough coverage, and all of a sudden now you've got to come out of your pocket for $300,000 or $400,000 to pay to the other people because your auto insurance has been exhausted. That is going to impact the way you live out the rest of your life. And you can't just go back to work.
Right.
At 70 or 75.
Right.
First off, if you've been retired for 5-10 years or more, you're not worth what you used to be to the workforce. You're not going to be able to replace that income and just go back in. And not to mention, do you want to? Yeah. So an umbrella policy oftentimes is going to be in the range of $100 to $200 for $1 million in coverage. Certain companies will go up to $10 million. And I'm working a case right now to try to get that done. There's some serious underwriting that has to be done just to make sure that the insurance company wants to be on that risk. But that helps to ensure essentially what's in your safe stays safe. So that you're not going to be devastated by the unexpected occurrence, whether somebody slips and falls down your stairs and they get hurt and they sue you, or you had a party and the deck collapsed and and all of a sudden there's 4 people suing you. That umbrella policy is going to be the best peace of mind that you've bought.
Yeah, that's awesome. All right, last question. And we're going to call this the one thing takeaway question. Okay, so you've given us tons of great information, by the way. So here's the question: whether somebody owns their first home, or they own a multi-million-dollar estate, if they were to do one thing immediately after this episode to check the health of their insurance, what should that be?
Make sure it's in force. Make sure it's active.
Does that really? I mean, it
can. Yeah, it definitely happens. We try to not let it happen as much as we can. But there are things that fall through the cracks. Like we'll typically, with certain companies, they'll mail us a notice. And during certain times in the past 5 years, the mail has been less reliable and there's been a delay. And we may get the notice afterwards that a policy hadn't been paid. So the first thing to do is, first off, just make sure your policy is in force. Second, look at your mortgage company that's listed on the policy. If you have a mortgage and you've done any kind of refinancing in the last 2 or 3 years, the mortgage company may or may not have communicated with your insurance company, and your insurance company may or may not have processed it. But if the mortgage company that's listed on the policy is incorrect, we're sending the invoice to pay your homeowner's insurance to the wrong company. And so they wouldn't. Now, typically, then they'll send an invoice. If they don't receive the money, they'll send the invoice to the client. But it's not uncommon or not unheard of to have a client receive that invoice and be like, and dismiss it because their mortgage company was supposed to pay it. And they don't take the extra step of questioning, hey, why did I get an invoice? Has this not been paid? So it sounds very elementary, but just make sure your policy is active and the right information is on there. And then look at the amount of coverage and make sure it makes sense to you. Obviously, there are some counties where you can readily see what the value of your land is. And, just kind of take a look at what you've got the house insured for. You can, a very rudimentary approach to it is just go to Zillow or whatever, real estate website, and look at the market value, subtract out the land. And that should be in the ballpark. It's not an exact formula because there's some subtleties. Make sure that if you see this doesn't make sense to me, call your insurance agent and say, hey, am I insured for enough? I just want to make sure. And they should be able to update and reassure you, provide you their home evaluator, and kind of re-justify and kind of ease your worried mind.
Those are great. So do that immediately. Don't wait. Don't wait don't wait a week. Don't wait till tomorrow. It's we're here. We're in the week. We still got time. Call your insurance agent. Right. Let's check on all those things. This has been great, Bryce. This has been a lot of fun. I've enjoyed it. I've been so informational. I feel like I just went to Home Insurance 101 and got all these answers because I'm literally just blown away. I've got my mind is just racing. How can people get a hold of you?
Call me. My phone number is 919-342-9732. We've had the same number for the last 20 years or so. But yeah, that'd be the place. Just give us a call. I love, we've got younger clients who like to email, and email is a phenomenal tool. But I'd love to get a phone call with you for the initial part. There's so many conversations that we get to have that knock out and are a lot more thorough than trying to do it over email. So a good phone call, and then we can use email as a tool, going back and forth and wrapping things up. But if you can, the phone works very well. I can hear whether or not I'm explaining something well to somebody, far greater than I can on an email.
So give the phone number again.
It's 919-342-9732.
And let's just say they want an email and say, I want to do an email to get a phone call.
Yeah.
If they were to email you, where should they go?
All right. So prepare your wrist. It's Bryce, and that's BRYCE at Harbor Trust Insurance, all spelled out.com.
Love it. Perfect. Well, this has been great. Thank you for being here with me. It's been so much fun. Folks, it's the show. You know what we say to you? This is where real estate matters. We talk about real estate matters that matter to you. You had a lot of choices. You chose us. Thank you for doing that. Give us a thumbs up on YouTube. Wherever you're listening to the show by podcast, give us a 5-star review. Tell your friends. It really helps grow our show. And we appreciate you so much. I say to you all over the world, we're so grateful for you. And that is this. Ciao, everybody.